banks have reported over the last. You're welcome. Over the last couple of days, and I'm told that you actually may think there's an opportunity there in terms of the value.
I think there's a big disconnect in the market right now, David, between where companies like electric utilities are being valued, something like 20 times earnings, and a typical bank at maybe 8 or 9 times earnings. Through a long period of history, those two industries tended to trade at about the same PE multiple. The banks are growing the top line, they're improving their efficiency, so net income is growing faster than revenues, and most of them are repurchasing something like 10% of their shares, and additionally pay a dividend yield that's greater than what you can get in the fixed income market. Investors instead are enamored by the electric utilities, I think taking massive valuation risk in return for not being exposed to much concern about earnings estimates getting cut whenever there are trade war concerns or recession fears coming up. So it's the trade-off of long-term risk versus short-term risk. And we at Oakmark have always wanted a valuation tailwind behind us and are willing to take on the short-term risk to obtain that.
Right. You know, the interest rate picture and forecast wouldn't necessarily seem particularly good right now if you're a bank. Net interest margin, which is always a focus, Bill, would seem to be potentially pressured.
Well, you know, the banks basically have a deal with their customers that they don't give them as much interest income as they could earn on a treasury bill in exchange for providing a bunch of services at no charge. That business model gets challenged if we go down to a zero interest rate environment. But at the levels we're at now, some of the companies that we own, like Capital One and Ally Financial, they're basically internet banks that don't have the large branch structure costs that the larger banks have. They're offering competitive interest rates today. They're still putting their money to work on high return loans. And we think the environment is actually a competitive plus for them. For the larger banks like a Bank America, if we went to a zero interest rate environment, they'd have to change their business model. They're providing valuable services to their customers, and they're not going to do that for free.
Hey, Bill, I've seen some commentary this week arguing that if the 10-year yield crosses, say, 1.8, not too far from where we are now, that maybe you do see a breakdown, a larger breakdown in these low-vol names that we've seen outperform so long. I wonder if you think that makes sense, and if so, where you think that line is on the yield.
I don't have a good idea of where that line is exactly, but I was watching earlier this morning when one of my heroes, Lee Cooperman, was on, and he was talking about how he thinks that a better level for long-term bonds today, more representative of what's going on in the economy, would be at the 4% level, that the stock market's reasonably valued, even if that does happen to bonds. And I would agree with that. And any move toward that 4% level, I think, would be a big negative for the fixed income substitute or safety stocks.